It's time for the Your Personal Bank Show with Ferenc Toth, President and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. It's Ferenc, and we're going to have a great day today. Hey, I just want to say that I'm going to cover some stuff today in terms of some things I've been dealing with some clients recently. And so I'm not going to spend a lot of time explaining how the concept works. We're going to talk about some of the questions and specific issues that have come up, like I said, and how to best maximize your personal bank tool to maximize cash growth, minimize minimize taxes. And, you want to maximize interest. Wow, what am I saying? Anyway, and, there's a couple of really cool things. One is a product, the way you structure the product, again, to minimize taxes, grow. Basically, if you access this, grow money income tax free and access the funds income tax free if used properly. I'm going to explain that further. Tax favored is one of the terms that's popularly used, but I'm going to show you how to accomplish that. And then there's some exciting new developments in the world of your personal bank in terms of the tools. There are some options in terms of how to access the funds that allow you to get a positive arbitrage on your borrowed funds. As you access your funds, you can basically earn money on it. So you can use it, take the money, use it elsewhere, and actually earn money on the borrowed funds, which is positive arbitrage, which is how banks operate. And so I think the first thing I want to do is, if you want to know more about how the personal bank works, we're going to touch on it briefly, but go back to some of the previous shows that are recorded and go to yourpersonalbank.com. It's right on the front page there. You can go to any of the previous shows. Last couple of weeks, I'm sharing some more things about my background, some of the bigger picture things like, reducing stress, reducing financial stress. Last week we talked about the 80-10-10 rule. Basically live on 80%, put away 10%, give away 10%. It's just a financial literacy, tool for the ages. So, break it at your own peril, if you know what I'm trying to say. But like I said, today, again, if you're going to operate like a bank, now, like I say, why is that important? You want to think like a banker versus an investor. Okay. Now, why is that important? Well, again, you can like banks, you can hate banks. It doesn't really matter. But I think we can all agree that banks are savvy about money. And again, for those of you that don't know, part of my background is I'm actually chairman of the board of a bank in formation currently. So we're in the process of starting a FDIC-insured bank, working with the Federal Reserve and FDIC and all those fun organizations. It's actually been very interesting and educational for me as a financial person, last 22 years, working in the financial world, learning about banking. And it's another whole arena, if you will, of the financial world that, frankly, most people are just not that familiar with. They have experience with banks. Of course, you have your checking and savings deposit accounts and things like that. Most people have various types of debt instruments like credit cards and mortgages, lines of credit, things along that line. But they really don't really understand how banks operate. And here's the thing. It's really important, if you're going to operate like a bank, be savvy with your money like a bank, you have to understand how to think like a banker versus an investor. And I'm going to touch on that again real quick. Basically, what is the difference? We're all taught to be investors, okay? Pretty much across the board, that's what we hear. That's what's drilled into our head. That's what, all the advertisements are about, Wall Street, all that. They, put that into our head to, invest your money, okay? And you put your money at risk to, the goal is to have it grow over time, your nest egg, and get a return on that. You take on some risk, calculated risk, of course, to get a return. And that's really how an investor operates. We trade hard-earned dollars for assets with the expectation the asset will increase in value. Now, unfortunately for most of us, and you know what I'm talking about, whenever you're at a dinner party or you're out with some friends or whatever, any kind of social event, and somebody starts talking about investments. And invariably, what is it that they always mention when they're happy about an investment? Well, I made X amount of % return, right? In other words, they're focused on the gains, okay? And don't get me wrong, gains are important. That's one of the primary reasons why you invest is for the money to make more. The problem we run into is a lot of people focus on that almost exclusively. I think it was Roy Rogers that said, I'm more concerned about the return of my money. I'm more concerned about the return of my money than the return on my money. That's a very valid point, a very valuable point. What are the tax implications of a particular investment? What are the likelihood of the return of your money? Okay, that's obviously important. Is there any protection, guarantees? What's the downside risk, right? I think in most cases, taxes and some type of principal and protection, if you will, are probably in many cases more important than what's the returns. Because who cares what the return is if you lose it, right? Doesn't matter. Reminds me of a client just recently. I was talking to her. She was like, well, she lost $140,000 in a real estate investment. And her response to me was, well, it sounded great. He told me I was going to get a 20% return on my money. And my response was, the return didn't matter. You lost, $140,000. So the return is immaterial at that point, isn't it? It's more valuable to understand what is the risk. Okay, and in that case, it was a bad risk. And I said to her, I wish you had talked to me about this before. Whether you did it or not, it was no skin off my nose, if you know what I'm trying to say. But she didn't get that third-party advice or look at somebody else and say, hey, what do you think of this? Or somebody with some experience or knowledge in that arena, frankly. I told her there was enough red flags that it would have been of concern to do that investment. Unless she said to me later, she was, I'll never do that again. In the future, if I've got a major investment decision, I'm going to talk to you about it or talk to somebody about it who has some experience and knowledge in that area. Because it's just too easy, what is it? A fool and his money's soon parted. It's too easy to have that happen. So again, what is the difference? Well, again, investors trade the hard-earned dollars with the expectation the asset will increase in value and focus on potential gains almost exclusively, unfortunately. Most of the time, most investments don't create much, if any, cash flow. And by the way, cash flow, I've talked about this in earlier shows. Again, go to yourpersonalbank.com and you can listen to those. Cash flow, we need cash flow more than we need appreciation in most cases at most points of our life. I always talk about, when you're starting out early in your career, what do you need financially? You need money, you need income, cash flow. If the car breaks down, the roof leaks, what do you need? You get sick or hurt and can't work, lose your job or business because of the economy or whatever. All those, and of course, when you retire, all of those different scenarios or stages in our life, we need money, income, cash flow. Appreciation does us little or no good in those circumstances. What does us good is having an ongoing income stream, okay? So, and then again, the last thing what most investors fail to do, or what I find my personal experience is 22 years working with clients and in the financial world, is they far too infrequently really ask or look at or consider, what's my plan B? If things go wrong, if things go sideways or backwards, what's plan B? See, the banking world always looks at risk assessment. And here's the thing. I've come to learn, no industry looks at risk assessment more than the banking industry. There's always a plan B and probably a plan C and D, frankly, okay? My point is, what's your plan B? What's your option? If this investment doesn't work out, things go backwards, what's plan B? What's your recourse, if you will? And I always say, look, if you purchase a stock, piece of real estate or business, can you tell me about what it'd be worth in a year? That's the big challenge in investing. We just don't know. We can take educated guess, we can look at charts, but we just don't know. When I come back in the next section, we're going to talk about how to eliminate those problems and how to move forward, create cash flow, create tax-favored income, and always move forward, taking advantage of those upswings and the positive results, but yet having a recourse. I'm going to share with you how that works. You're listening to the Your Personal Bank Show, and contact us at yourpersonalbank.com or toll-free 866-515-6280.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We've been talking about how to think like a banker versus an investor. Just to finish up on that thought from the last segment is investors. What's the difference? Again, you can like banks, you can not like banks. It doesn't really matter. We can agree that banks are savvy about money. And like I said, I've been learning a lot about banking as we've in the process of opening. I'm the chairman of the board of a bank in formation currently. So I've been learning an awful lot about banking over the last couple of years. And here's the difference. What is the difference? We're taught to think like investors versus thinking like a banker. The difference is this. Investors take hard-earned dollars, trade those dollars for assets with the expectation the asset will increase in value. And the problem that causes is, if you buy a stock, real estate, piece of a business, whatever it is, can you tell me what it'd be worth in a year, 3, 5? You just don't know. You can look at charts, you can guesstimate all those different things, but you just don't really know. And one of the common things that's in many books, by the way, investing primary for appreciation is just another form of gambling. I didn't come up with that, but the reality is if the only way to make money is for it to go up, you don't really have a recourse if things don't. You just lose money. What's the difference? And they've got a point. The return's uncertain. There's little or no cash flow in most cases, and there's just no downside protection. So how do bankers operate? Well, bankers look at things a little bit differently. In other words, we've all taken mortgages or car loans at some point in our life. I shouldn't say all, but most of us have. And when we signed the papers, we knew we would have a payment, right? Did you plan to make the payments? Well, of course you did. You wouldn't be signing the papers otherwise, right? And guess what? You went through an approval process, and the banker, the lender, knows that also. They know with a very high degree of likelihood you are going to make those payments, okay? And in the off chance you did not make those payments for that car or that house, what would have happened? Well, they would have ended up taking it, reselling the asset to someone else, and getting payments from them or an income stream. See, what the banker's done is created a secure cash flow or income stream for them, your payments, and protected their downside. That's what collateralized loans are all about. By the way, if you want to understand the risk involved between collateralized loans versus non-collateralized loans, well, collateralized loans are your cars and houses and things like that. Non-collateralized loans are personal lines of credit, credit cards, and those types of things. What are the interest rates typically that you pay for a credit card, for example, versus a mortgage or a car loan, given similar credit history? So if your credit score is, typical, average, decent credit score, what's the interest rates you're paying? Well, on a home or auto loan versus a credit card, easily 3, sometimes 4 times more interest, right? Credit cards are commonly in double-digit interest most of the time, right? And the difference is, again, it's about being collateralized versus non-collateralized. The ability to protect the downside or have a plan B if the payments aren't made, that shows you the level of the level of risk, the risk assessment that the banking industry, the lending industry has made on those types of loans. Why is this important? Well, if you're investing your money in something, what is your protection to the downside? What's your collateral? What's your plan B if it doesn't work out? And you should be getting 3 to 4 times greater rate of return, according to the lending industry, on a non-collateralized investment, an investment where you have no recourse to the downside, than one where you do. So, again, why is that important? Well, based on my experience as a financial person and now as a banker, is that I find most people, in my experience, take on far, far too much risk on their investments. They really kind of roll the dice, if you will, and hope it works out. And when I ask the question, oftentimes the answer I get when I'm looking at statements or I'm sitting down with somebody and we're going over their financial situation, and I'll ask them these questions, and one of them is, well, let me ask you this particular investment here, why did you do this? What was your thought process? What was your goal? What were you trying to accomplish? Or, what are your goals? And the answer I get the majority of the time, sadly, is, well, I don't know. I put it here because that's what everybody else did, or that's what some guy told me to do that at the bank or at work or whatever. And let's face it, I think, folks that are listening, maybe I'm preaching to the choir here on Money Radio, but that's not a good way to invest your money, right? There should be some strategic planning involved. And that's why having a financial advisor is important, but also understand the risk. And, when you find if someone's downplaying the risk at what you can lose, be cautious about that. As a bank, putting my banker hat on, you want to keep that in mind, okay? So, what is your personal bank? It's really quite simple. We've gone into it in previous shows. Like I said, go to yourpersonalbank.com. You can watch any of the previously recorded shows and go into more detail about how this works. But very briefly is, if you're going to operate your own bank, you got to understand how banks operate. And the reality is when we get a check, what's the first thing we all do with it? Well, we deposit it in the bank, right? What does the bank do with our deposits? They loan it out. Cars, houses, credit cards, various things. And here's the thing. What do banks really do? Let's say you walked in the door and you wanted to open an account. You gave the banker some money. Next person walks in the door, wants to get a car loan, and they get approved. Does the banker take the cash you just gave them and turn around and give it to the car loan person? And it's funny, when I ask that question, most people think the answer is yes. The reality is it's not. What banks do is they take the cash you gave them, stick it in the safe. Now, the question is always, is cash an asset? Well, of course it is. Can you borrow against an asset? Of course you can. We do it with houses and cars and 401ks and such all the time, right? So what does a bank do? They take the money. They don't invest in the stock market, by the way. Interesting. Again, remember we said earlier, banks are savvy about money. You can agree or disagree with banks and how they operate or whatever, your feelings towards them. But I think most of us would agree they're savvy about money. And when somebody's savvy about money like that, or an entire industry is, you can learn from them. And by the way, it's public record. Pick any name, any big name you want. They don't invest in the stock market. What they do primarily is they earn compound interests on our deposits. And they borrow against that cash they hold in their safe to earn more interest. So can you. And that's really the bottom line point of the personal bank. And I'm going to share probably in the next segment some exciting new developments in this arena. Super exciting, actually game-changing changes to the better on how you can get a positive arbitrage on your money. See, what your personal bank does is it creates an asset that's guaranteed and insured. So it's protected, okay? So you've got that downside protection. You got that recourse if things don't go well. You have access to your capital pretty much right away, okay? The majority of it, all right? If it's set up correctly. You can earn interest on your asset and the borrowed funds. This is where it starts to get really interesting, and this is where you start operating like a bank rather than an investor. By the way, you can also grow your money income tax-free and access it income tax-free, again, if it's structured correctly and used correctly, which I'll go into further. So the bottom line is the tool we use is an insurance tool. It's a very specific type. It's not something most people are familiar with. And the reasons are simple. We create compound interest. We want increasing cash flow every year. We don't want a risk of loss. Like I said, you don't want to borrow against an asset that can lose value. That's a recipe for disaster. We want liquidity. You want access to funds. You want to have access to half or more of your money. Okay? And you don't want to have other restrictions or limitations on your money like tax penalties or other penalties involved. Okay? And like I said, if it's done properly, you can create income tax-free growth and income tax-free access to your funds. So it's a really exciting tool. And like I said, I'm going to share with you how you're going to be able to earn a positive arbitrage situation, okay, on those borrowed funds. And those funds you use elsewhere to do other things with, yet still earn on those monies and earn compound interest going forward. And look, if you don't understand how powerful and beneficial compound interest is over time, go to one of our previous shows on yourpersonalbank.com, and I go into more depth, of course, but it's probably the most powerful tool financially that you'll ever deal with. It's called the eighth wonder of the world by many people because it is so powerful. And again, the key is thinking about the insurance tool as an asset versus an expense. That's my biggest challenge, is always. I mention insurance. Some people get glassy-eyed, if you will, and they say, oh, great, I don't need another bill, and they need an expense. I got the home, the auto. Last thing I need is another bill. That's not what I'm talking about here. I'm talking about a high cash value tool that grows cash. It's an investment tool, if you will, to grow money rather than a protection tool. It has some protections involved with it, don't get me wrong, but its main focus is to grow cash. And, we can go online and research and look this stuff up, and you can look up things to say insurance is a bad investment. It's everything's, it's all out there. The reality is they're looking at policies primarily that are not designed to generate cash, maybe a little bit, but they're really death benefit protection tools. That's the thing you need to understand. And those tools are not designed to generate cash. What I'm talking about is, I'm going to go into the next segment and we'll talk more about how that works and how you can structure a contract, a policy that'll grow cash for you, give you tax-favored benefits, give you access to your money for whatever purpose you need it for, opportunities, paying off bills, expenses, whatever it may be, and still earn interest on that money, just like a bank. You're listening to the Personal Bank Show with Ference on 1510 AM or 105.3 FM. Contact us at yourpersonalbank.com for more information.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, we've been talking about a lot of great stuff here regarding your personal bank. We've been talking about your money. We've been talking how to think like a banker versus an investor, create tax-favored growth, increase cash growth, access to the funds, all that good stuff. And like I said, the key tool is the key concepts, think like a banker versus an investor. Protect that downside. Grow your money, yes, absolutely, but also protect the downside. Make sure you have a plan B or a recourse. And then, of course, the tool, it's a high cash value product. It's not a typical insurance tool that most of us are familiar with in terms of a death benefit protection tool. What I mean by that is real simple. Most of us, when we're purchasing life insurance, for example, the focus is how little can I pay? How little premium can you pay to get the maximum death benefit? I mean, that's what it's all about, right? What's the least I can pay to get the biggest bang for my buck? Because, you're protecting, it's a protection tool. It's not, I like to say, most people, when they say they have a life insurance contract, in reality, they don't have a life insurance contract. What they really have is a death benefit protection tool. People laugh, but it's true. Because the reality is, if you're the insured, will you ever receive any money? The death benefit, I should say. Will you see a death benefit proceeds? The answer is no. By definition, you have to be gone for it to pay out. Your heirs will, of course, and there's definitely value in that. No question. I don't argue that point. In fact, I have some of that myself. And you should have death benefit protection if you have those needs, like family, business, etc. Okay? Make sure those things are taken care of. But that can be done these days. We hear about term insurance and things like that, advertisements all the time. That type of protection can be done fairly inexpensively for most people, very inexpensive for most people. Okay? This is not what I'm talking about. Now, if you want some of that or need some of that, yeah, I can help you shop it around, find the best deal. Heck, frankly, you can go online, okay, and find it. Take care of the death benefit protection needs you have, but this is not what we're talking about. It's like flipping everything on a dime. Everything you've understood about insurance and how it works, most people don't really understand that these options are even available. I talked to a workshop of 100. I'll have 100 people or so, investors in the room, and I'll ask how many are familiar with this type of tool, and I'll get 2 or 3 hands typically. That's it. And these are people who are focused and interested and understand money. Most financial advisors don't specialize or have a strong background or understanding in this area. It's not their fault. They're focused on other things, okay? This is very much a specialty. This is very much of it's a specialized thing. I'm like the specialist doctor, if you will, not the general practitioner, if that makes sense from a medical standpoint. So like I said, it's a very specific type of high cash value tool. It's designed to grow cash. And again, most policies, most contracts are not. They're designed to maximize death benefit. Let me give you, and I shared a couple of shows previously, one of the secrets. As more and more people are starting to become aware of this, which is great. I'm excited that the awareness of using this tool is starting to grow. Okay. I remember, gosh, like I said, I've been in the financial world 22 years. I was one of the early proponents of fixed index annuities. Okay. And I was one of the top 10 producers in the country of that multiple years with one of the top 2 index annuity providers in the country. It was funny because when we first came out, all you heard about, and there's still a few people out there, not many, but in the early days, oh my gosh, just the clamor out there almost, how annuities are bad and don't do this and all blah, blah. Yet every year fixed index annuity sales keep growing just about every single year, and I think it's over $1 billion of new business every year now. It's become a massive, huge part of the financial industry. Even the former players, some of the players out there, providers who used to bash annuities, now offer them because it became a situation of where if you can't beat them, join them, if you know what I'm saying. And particularly after the 08-09 financial crisis, fixed index annuities became quite popular because of that downside protection. People understand, hey, I can grow money and I can have market-related type of growth without the downside risk. I'm interested. I don't care what somebody's saying out there, saying this is bad, this is bad. What I can tell, I used to get people to say all the time, I look it up, I look online, and all I see is how annuities are bad, yet everything I look at and I can't see where it's bad. It's exactly what I'm looking for. It's what I want. I want to grow my money and have downside protection, for example. I have hundreds of those clients, and we still have some of those today. We still do annuity stuff, for people, when it's the right fit. I guess I'm kind of a trailblazer, or a pioneer, if you will. 7 years ago, I was introduced to the personal bank concept, started using it myself personally with our business, and then started sharing it with clients after using it a year or two. And I've seen tremendous results personally through our business and with our clients since. And at first, I would share this idea, and people were like, what's that? Or I'd hear the negative bashers like anything else. And funny thing is, I'm starting to see the same kind of cycle where it's becoming more and more, starting to become more and more known, and people are realizing, wait a minute, this is something I've never looked at. This is a financial tool that could make some sense. And by the way, folks, corporations, banks, financial institutions, wealthy individuals, executives commonly, and I mean commonly, use this as a financial tool. Because when you say you can grow your money income tax-free, you can access it income tax-free, who does that immediately, if it, again, done properly, who does that immediately appeal to? Any high-income earner. So guess what? They're immediately attracted to the idea or willing to take a look, okay? The guarantees, the safety, the long-term care, the death benefit protection, but most importantly, the cash growth with the ability to access those funds and get a positive arbitrage situation is tremendously powerful. And again, if you haven't looked at this, or if you did and the numbers didn't seem to make sense, I'm going to strongly encourage you to look at it again, because recently, and coming out very soon, are some new enhancements to these tools that allow you to increase potentially your returns even when you've accessed and borrowed the funds for other purposes. Now, I'm going to explain this a little further. See, when you access funds from one of these contracts, the goal is, first of all, I always tell people, look, the primary goal for any financial investment, almost universally, is you're building money long-term for retirement, right? I mean, that's almost always the main primary goal, long-term. But the advantage that the personal bank has that you don't see, it doesn't exist basically for other types of investments, is when in the shorter term, in the process of the next 1, 5, 10, 20 years, while you're building this nest egg, we always heard, you put away money, forget it, set it, forget it, it's long-term, no touch of money, that kind of thing, because you're building it for retirement, right? Well, that's true for most investments. But for the personal bank, you have the option, the ability to access cash, funds from the account, while you're still building the nest egg. Now, this gets tremendously interesting, because why? Do you ever have situations where you need money? You have a need for some money because you have a bill, you have an emergency, you have an unexpected expense, job losses, business losses, the economy. I mean, all those things happen, right? Those just happen to us. Or do you have a situation where you see an opportunity? You see an opportunity that you can invest some funds and create a nice return on that, whether it be your business or some investment or whatever it may be. If you take funds from that long-term, no-touch-'em retirement money, what happens? Well, the growth stops because you took it out, right? And here's the thing. For example, if you were making 7% on that money, that long-term growth money, and you take it out to invest in something else or pay off a bill or whatever, gosh, you better be making more than what you were earning. So if you were making 7, you got to make it more than 7 to make it even make any sense, right? I'm going to go into further detail in this next segment about how to get this positive arbitrage and how not to look at, one of the biggest mistakes I see is look at your money in a vacuum. In other words, look at the whole picture. I'll explain that further in the next segment. This is the Your Personal Bank Show on Money Radio, 1510 AM, 105.3 FM. And tune in every Tuesday at noon to listen to our show or contact us at yourpersonalbank.com.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
All right, here we are, rounding third, coming into our last segment. We've been covering a lot of great stuff today. We've been talking about how to think like a banker versus an investor. Guess what, folks? There's a difference, a big one. Also, how does your personal bank work? We've covered that. Why you should consider it. Okay, we've covered all those kinds of things. The last thing I really want to talk about, and this is probably the thing I've been leading to the whole day, is there's been some enhancements that are exciting on these tools on how we can access funds, and in terms of while accessing those funds for other purposes, still earn money on it, just like a bank does. And see, here's one of the biggest mistakes I see many investors make. We'll put it that way. They look at their investments in a vacuum. What do I mean by that? In other words, they'll look at their financial account, their investment, whatever it is, and they'll look at what their rate of returns are and various, are they making money, losing money, various things like that. How much have they contributed and all those good things. But what they don't look at is the whole picture. In other words, and the statistics show that many Americans, are carrying debt, a significant amount of debt, in fact, in many cases. And a lot of folks are carrying credit card debt, for example. I'm going to use an example. Not too long ago, I was met with a couple, and their combined income was around $200,000 a year. Successful folks, lived a nice home, family, the whole thing. I mean, long-term, successful people in terms of earning money. And then as I got into their financial situation further, they had something like $45,000 of credit card debt. Now, I kind of had to look at it a little bit funny, and there were some other debts too, car loans and various things, but of course mortgage and such. But I said, let me ask, I got to ask you, if you don't mind, what is this with this $45,000 in debt? Well, it turns out the wife had a higher paying job previously, lost that position through no fault of her own, frankly. Had to get, found another position that paid her roughly half. And frankly, the previous couple of years, they'd been living on, let's face it, they've been gotten used to that lifestyle. It's easy to do. We get an increase in income. It's easy to live up to that level. It's kind of hard to go backwards, isn't it? So it's like $50,000, $60,000 a year pay cut, if you will, or reduction of gross income. And they were still living like they had the previous income. And I asked the question, is this kind of a long-term change? Is this temporary? And they were both assured me, no, this was a permanent income change. So they had to change their lifestyle a little bit. They had to change their expenditures, if you will. My point is this, and I run into this far more often than most people would care to admit, frankly. Here's the problem. Let's say, for example, I'm going to use some simple numbers, some simple math. The numbers aren't important. It's the principle that is. But let's say you had $50,000 invested. And let's say you got a 7% return on that. Well, 7% times 50,000 is $3,500. Okay, you gain $3,500. Let's say you had $25,000 of credit card debt, which isn't much higher than the national average, by the way. And let's say your credit card debt interest is 14%, which, by the way, I think most of us would agree is pretty good. You'd have pretty good credit to get a 14% credit card. Most I see are 16, 18, 20 plus. Let's say you had 14% on $25,000 of credit card debt, and you paid the minimum payments, whatnot. Bottom line is you're going to pay about $3,500 of interest in a year. So you had $50,000 invested, you have $25,000 of debt, you're earning 7% on your $50K invested, you're paying 14% on your credit card debt. You earned $3,500 that year, and you paid $3,500 in interest that year. What was your return on your money? 0. My point is this. Now, there's other factors to get, of course, if you've got 401ks and company matches and stuff, you want to take advantage of those because those are free money. I get that. But my point is, if you got $50,000 invested growing at 7 and you got $25,000 of debt getting charged at 14, you are not moving forward. You're not making any money. And the other thing, a couple other things to consider. That debt, see, here's the thing. You could be making 7%, but we all know in most cases, if you're in the market or whatnot, that varies. Some years you're going to make more, some you're going to make less. A lot of people don't like me sharing this in the financial industry, but there's a study called the Dalbar study, DALBAR. You can look it up, or you can contact us at yourpersonalbank.com. We'll be happy to send you the study, but it's they've been doing this for the past 30 years. It's a statistical research company that has statistically takes thousands of actual IRA and 401k returns annually. They take the information on the statements. They take out contributions that are made and look at the actual returns net of all fees for the average American. And I share this in my workshops and stuff, and I've even had people, give me a hard time about it and all that. But you know what the Dalbar study says? The average American has been earning pretty much every year for the last 30 years on their IRAs, 401ks, average, last 10-year returns. A little over 2. Net of all fees, net of everything, 2.2, 2.3 is the numbers that typically come out. If you don't believe me, look it up, or we'll send it to you, like I said. That's what people are actually really earning out there. And by the way, 22 years in the industry looking at statements, I find that to be pretty accurate. The thing is, and that's not guaranteed in most cases because it's market related in most cases. The credit card debt, if you have 14% interest on your credit card and you make minimum payments, are you going to pay 14% interest? The answer is yes. That's a guaranteed bill. That ain't changing. And what if it's worse? Your rates are worse. So if you're not making 7, you're making closer to the national average, 2 or 3, net of all fees. By the way, most people say, well, I made 7% last year. What they're discounting, by the way, they're discounting their contributions. That's one of the biggest mistakes that's made out there. It's study after study shows that. They underestimate how much they've contributed. Yes, their account grew 7% last year, but they added 3 or 4 of it. That's what's common. There's exceptions to every rule, don't get me wrong. But that's what's the average. That's the statistical average, folks. Okay? When you have a double-digit expense, that ain't going away until you pay it off, is it? So that's guaranteed. You're going to have to pay it. So my point is this. Having a personal bank where you can access the funds, and by the way, you can access it in a fixed loan option where you're guaranteed. Basically, currently it's 5%. You're getting paid 5%. Those are the current rates. So in essence, it's a wash. It's a wash. It's free. There's no cost, if you will. Okay, if you pay it back in anniversary dates. If you don't, there's currently a 0.5% loan fee. So maybe it costs you 0.5% or whatever. Okay, but if you have 5%, 10%, 15, 20% debt, isn't it better to pay 0.5 point to get rid of the double-digit debt? And here's the thing. If you pay off a bill and it increases your monthly income by $1,000 a month, or you have an investment that increases your income $1,000 a month, is there a difference in the bottom line? No. In other words, you should be just as excited about paying off debts. Most people are not, but they should be, as earning. We get excited about earning more. We don't get excited about paying less. Guess what? The net effect, if the numbers are the same, is exactly the same. You should get excited. By the way, getting rid of the debt is even more powerful because that's a guarantee. Investments in many cases are not guaranteed to earn those kinds of returns, okay? That's why it's so powerful, folks, okay? And then the last thing is, How about taking the money, and there's a variable loan option. Currently, the rate you pay it's based on the Moody's bond index, the average, which is currently 3.41. Now, if you're getting credited 5% on your money and you take it from your personal bank and they're charging you 3.41, what's the difference? About 1.6 net difference, positive arbitrage. You can actually be in a position where you're getting credited 5%, getting charged a 3.41 currently. Again, those are current rates. That can vary. My point is, you would in essence make about 1.6% on money you borrowed and used and spent elsewhere. And what if you paid off a bill and got rid of 15% interest, for example, or even 5% interest? See what I'm talking about? It's powerful. Contact us for more information at yourpersonalbank.com or toll free 866-515-6280. We'd love to sit down with you and share with you how this tool can really enhance dramatically your financial future. Think like the wealthy, operate like the wealthy, and then you will become one of the wealthy. Tune in every Tuesday at noon for Your Personal Bank Show on 1510 AM or 105.3 FM.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.
This show is designed to provide accurate and authoritative information. The presenter and guests on this program do not engage in rendering legal, accounting, or tax advice. Expert advice from a professional involving your specific situation should be sought, if required. Permanent life insurance is a long-term investment. Products, optional features, and riders may have limitations, restrictions, and additional charges and may not be available in all states. Withdrawals beyond principal may be taxable income. Excessive and unpaid loans may cause the policy to lapse. If a policy lapses, unpaid loans are treated as distributions for tax purposes. Replacements may not be suitable for everyone. There may be penalties and surrender charges when replacing coverage. New products may include new surrender charges and contestability period. Policy guarantees are based upon the claims-paying ability of issuing insurance company and do not apply to the investment performance or assets in the underlying variable portfolios. The life insurance and annuity products in this presentation are not FDIC insured, may lose value, and are not bank guaranteed.